Let's now have a look at learning objective number 3. In learning objective number 3, we're going to concentrate and have a look at the effects of the different accounting methods for inventory on the cost flow that we observe, as well as the effects on the profits of the business. We're not going to look at tax in that much detail. Tax is something that's considered in later accounting subjects. So if you do a major in accounting, you'll learn more about that. But we will look at it briefly in this learning objective. Now, the purpose of the different choices we have in accounting are so that different businesses can use different methods that fit their particular characteristics. So for example, we've looked at the first in, first out inventory costing method. And for a business like a supermarket that generally sells the first units in, they're the first out the door, then the first in, first out method is the best method. And if we follow generally accepted accounting principles, one aspect of those generally accepted accounting principles is what's called the matching principle. And so for a supermarket, using first in, first out is the best method when following the matching principle, because we're matching our revenues we're generating with the actual cost associated with the inventory we're selling, because we assume first in is the first out. So if we compare the different inventory costing methods, specific identification is what we would regard as the most reliable one if you can in fact specifically identify each particular piece of inventory you are selling. Right? Now, this is not always possible. As I mentioned in the prior learning objective, the barcodes on items sold by supermarkets are exactly the same. The supermarket might buy different batches that cost different unit prices and different unit costs. So we simply don't know which item with absolute assurance we've sold. So whether it's from batch 1 or 2. So we need to make an assumption about the flow of inventory that we acquire and then subsequently sell. And so as you know, with first in, first out, the cost of the first inventory is expense first through cost of goods sold, because we assume we sell that unit first. So we match it with the revenue. And so therefore, in that particular case, for most retailers, first in, first out is the best method because it is best at matching the revenues with the costs that we actually generate. Last in, first out assumes that the last unit in is the first one we sell, which, as you know, is relatively rare. And in Australia, this method, as I mentioned earlier, is banned. And the reason why it was banned is for tax purposes. Now, I know tax accounting and financial reporting are two separate matters, and in this subject, we concentrate on financial reporting and not tax. However, for consistency reasons in this case, you are not allowed in Australia, or for Australian entities at least, to use the last in, first out method, right? And this method was used to minimize taxes, particularly where we had high levels of inflation. So for example, if we look in Australia in the 1970s, there was exceptionally high levels of inflation, which means the last units in could have been significantly more costly than the first units. Some entities opportunistically use the last in, first out method for tax purposes to expense and say they've sold the last units in out first, to therefore minimize the profit they were reporting for tax purposes and therefore minimize the tax they were paying. Now, given the last in, first out method is not applicable in many cases, for most retailers, it doesn't work. Buyers generally purchase the first units in, which are the first out. So therefore, it's banned. You're not allowed to use it. And so, as I mentioned, for consistency purposes, you can't use it for financial reporting either. In Australia, in some countries overseas, you can. So you need to know about it, obviously. The moving average method, as you know, determines the weighted average cost of inventory. So the cost of average inventory units at the time of sale. And so generally, if prices have risen or fallen consistently over the period, if you use the moving average method, you will get a cost of goods sold that is in between the extremes of the first in, first out method and the last in, first out method. So if we look at a table that summarizes the implications of the different inventory costing methods, what you can see is that the first in, first out method, if prices are rising, see this is circled up the top, will give you the lowest cost of goods sold, because assuming you're selling the first in, which is the cheapest, so therefore you're getting the cheapest or the lowest first in, first out determined cost of goods sold. So therefore you're getting the lowest cost of goods sold in that particular case. Now again, if prices are rising and you're using the last in, first out method, then you're assuming you're selling the most expensive ones first, therefore you're getting the highest cost of goods sold. Now, ending inventory. The inventory that you don't sell is obviously left in the books of the business. And so therefore, if you apply the first in, first out method, you assume when prices are rising, you sell the cheapest units, and so therefore you're left with the most expensive units at the end. So if you apply the first in, first out method, yes, you do get the lowest cost of goods sold, but you also get the highest value of ending inventory because the most expensive ones are assumed still to be on hand. Now, this scenario is reversed if you use the last in, first out method, because here you're assuming you're selling the highest cost units first, and so therefore you're left with the lowest cost units, the ones that came in first, on hand. So you're getting the lowest ending inventory value here. Now, moving average obviously is the average units we have on hand, and so that is going to give you the middle cost of goods sold, because it's going to be between the first in and last out extreme. So first in, first out gives you the lowest cost of goods sold, last in, first out gives you the highest, and so cost of goods sold using the moving average is going to be somewhere between these, and the same applies obviously for the ending inventory value. Now, if we now think about that, let's apply this logic to this question. So when inventory prices are falling, which will give you the highest cost of goods sold and the lowest closing inventory value? I would like you to now answer this question right now. Okay, so prices are falling. Now, if we go back to our previous slide, we can see here that we looked at this table in the context of rising inventory cost. So here we have falling inventory cost. We're looking at a product which we're assuming over time is falling in cost for the retailer. So therefore, this reverses the expectation, the effect on cost of goods sold and ending inventory. So if prices are falling over time, which will give the highest cost of goods sold? Well, the answer to that is obviously the first in, first out method. Because if prices are falling at the beginning of the period, the inventory cost per unit is highest. And so therefore we're assuming we're selling the first in first. So therefore first in, first out takes those numbers and incorporates them into our cost of goods sold. So therefore we have the highest cost of goods sold. It also gives you the lowest closing value of inventory, because the ones that came in last, we assume we still have on hand in the first in, first out assumption. And so therefore, accordingly, you get the lowest value of inventory in the balance sheet. Now, this is important. We need to remember that prices can increase and decrease over time. In Australia, we've been very fortunate over time that generally prices of inventory have fallen, at least in more recent years. Although, unfortunately, with a decline in our currency, so the depreciation of the Australian dollar, as well as shortages of inventory, because many factories around the world have closed as a result of COVID-19, what we will find in the coming months or year is some rises in the cost of inventory for retailers, which means those retailers are most likely going to pass that cost on to you with higher prices in store.